As the COVID-19 crisis fades and as life gets back to normal, it's worth asking exactly what did we learn? Hi everyone, I'm David Scranton, and thanks for joining me again on The Income Generation. You know, one silver lining in any disaster is that we learn from it. The coronavirus pandemic is no exception. Governments learned, scientists learned, and hopefully so did you. Today, we're going to take a look at 4 personal finance lessons that hopefully you've gotten from the COVID-19 crisis. Lessons that include expect the unexpected, be financially flexible, don't ignore estate planning, and remember to plan your retirement holistically. And helping me out as usual is income specialist and best-selling author, Jeff Small. We're also going to be hearing from our special guest, Dennis Gartman, the retired editor and publisher of the Gartman Letter, as well as income specialists Michael Burleigh and David Stearns. But first, let's talk about a lesson that really boils down to the Boy Scout motto, be prepared. Once the WHO declared COVID-19 a pandemic, the entire world changed. And even after the dust settled, the lingering impacts of COVID-19 really were just the beginning. In fact, the pandemic affected virtually every aspect of our lives, right? It hit us physically, it hit us mentally, and yes, it hit us financially. And in many ways, it hit older folks the hardest. Of the more than 600,000 Americans who died from the virus, most were over the age of 65. The unemployment rate for workers 65 and over hit over 15%, the highest ever recorded. Some people were forced to dip in their retirement savings, while others had to retire early due to layoffs or healthcare concerns. Now, yes, these are all tough situations, but in some cases, they could have been minimized or perhaps even avoided with better planning. And that highlights the first financial lesson from the coronavirus, and that's expect the unexpected. You see, you can't predict a pandemic, but there are ways that you can minimize the impact of virtually any sudden life-changing event. First, have an emergency fund. Have a savings account with enough to cover at least 6 months of expenses, because this will buy you time, essentially, in the event of a job loss, an illness, or any other tragedy. There should hopefully be enough time to help avoid any permanent financial damage. And that savings can go even farther if you don't have to put it toward credit card bills. So paying down debt is another great way to expect the unexpected. But you should also know your risk tolerance level. Even though the stock market recovered and hit new record highs, its dramatic drop at the start of the pandemic was a wake-up call for a lot of people, because folks realized for the first time how vulnerable their assets were to a major market correction. In other words, their financial strategy was wrong for the risk tolerance level, something we'll talk about more in a moment with Jeff. But first, let me take a moment to answer one of your questions. Elliot from Minnesota asks, how did the stock market recover so quickly last year when the economy was still shut down? Elliot, it's a great question, and the answer really lies in the fact that the stock market is forward-looking. And when the Fed jumped in to say they weren't going to let things fall apart, they were going to try to keep companies from going bankrupt, individuals from going bankrupt, the market said, okay, this isn't going to be as bad as we thought it could have been had the Fed and Congress not made these moves. So the market started to recover because, of course, markets are forward-looking. And even though the conditions at the time weren't great, the future conditions did look much better. And that was great news. However, that all changed then in November when we ended up getting essentially a vaccine, 2 vaccines for the virus. And with those vaccines, boom, now we have a snap of a finger, and guess what? The market hit new record highs and just continued to take off. So, Elliot, thanks so much for your question. And be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. Now, let's bring in Jeff. You know, it's amazing, isn't it? We were sitting here a year ago saying how bad can the pandemic get? How bad can things get? And now most people are acting as if it never existed, as if everything's back to normal. And we're saying, well, could we have another relapse of this Delta variant? Could things get a little worse? But most people think the worst is definitely over. So what a change a year makes, huh?
It's a huge change, and what a great question by your guest, because the topic of risk tolerance has never been more important, especially at these all-time stock market peaks, as the next 12 months is going to be challenging, Dave, for the market to continue its march upwards.
Yeah, it could be more difficult because we're seeing right now concerns about the Delta variant affecting individuals. We need another booster shot, so the market's getting a little more nervous, rightfully so. And frankly, now that we've done almost a 100% recovery in terms of the economy, now we're looking forward and saying, well, what is there next? What is there? And if we see signs of inflation on the horizon, if anything, that concerns financial markets. Inflation's not generally good for the stock market. So you're right. I think we got some bumpiness ahead. We're not going to see, I don't think, any major drops, but we could certainly see some downside and certainly a lot less upside than over the last 12 months.
No doubt about that. I completely agree with you. There's lots of challenges going forward, but in retirement, we're continually faced with challenges. And one of those challenges, Dave, is the amount of debt structure we might have as retirees/consumers. And so debt can be our worst enemy when the unexpected happens.
Yeah, it's funny. I think everybody knows that credit card debt's bad and car loans are really not good debt either. Although you can get some 0% loans. They think, oh, it's 0%, but it eats up cash flow. I say that even mortgage debt when you're retired for most people isn't good, because people say, well, gosh, if I can make 5% and I'm only paying 3% of my mortgage, well, I'm ahead of the game. Well, kind of, sort of, but they forget how much risk they need to take to make that 5%. And also they forget that they have to make principal payments. So all of a sudden, when they factor in the principal with the 3% interest, they're eating up that entire 5% interest payment in making their mortgage payment. So they're really not ahead of the game. So if you can go into retirement being completely debt-free, God bless you.
Well, I have to laugh, Dave, because that's exactly the opposite of what the Federal Reserve is doing with their blank check mentality and keeping the stimulus going. That scares me the most, is keeping that stimulus going, because that tells me they're afraid of the virus, Dave.
Well, they are. They're keeping it going. They're trying to keep everything running, and every time they drop interest rates, each crisis, they get a little lower. When they're able to raise the rates again, they don't raise them as high. So the Fed is really backing themselves in a bit of a corner, and it'll be interesting to see over the years how it all plays out. But bottom line, our model, investing for income, really, in my opinion, is all about expecting the unexpected. Because if you don't have any fixed payments because your debt's paid off and you're investing for income, you have a lot of interest and dividends coming in. Now, if something goes wrong, as long as you're in things that pay stable interest and dividends, you should be okay. And Jeff, that's something that I can't wait to interview our first guest about, who see what he thinks about the concept of how retirees should be investing today. And of course, that's Dennis Gartman. So again, looking forward to that. But before that, we need to take a quick commercial break. So stay with us. We'll be right back here in a moment on the Income Generation.
Are you truly ready to retire? Do you have the right strategy to pay for your lifestyle for the next 30 years or more? Take our free retirement readiness quiz at areyoureadyforretirement.com and discover what your retirement strategy may be missing. Don't let market volatility derail your retirement plan. Make sure you're fully prepared by learning about hidden risks to your retirement. Visit areyoureadyforretirement.com and take our free retirement readiness quiz.
Welcome back to the Income Generation. I'm David Scranton. In just a moment, we're going to be introducing today's special guest, Dennis Gartman. But before we do, today we are breaking down 4 financial lessons from the coronavirus. And so far, we've talked about the importance of expecting the unexpected. But now let's take a minute about lesson number 2, and that's being flexible. Now, when I say flexible, I don't mean a financial plan that you can change willy-nilly. What I mean is one that's diverse and forward-looking, that you can modify based upon changes in your life. The pandemic brought on major changes for a whole lot of people. Some lost jobs, some had to adjust their goals, some had to delay retirement. And others realized that they were just plain carrying too much risk. And when those things happen, you need a financial strategy that you can adapt, one that you can adapt to address these changes and to anticipate new changes. Now, one of the reasons investing for income works, regardless of market conditions, is because of its flexibility. In fact, the pandemic offered, I believe, a great example of how flexibility keeps the income model viable in the midst of market changes. For example, as the economy picked up strength again earlier this year, long-term interest rates rose, and this created a headwind for some income-based investors. However, the effects of that headwind were minimized in many income portfolios by diversifying and through active management. In addition, income investors who wanted to lower the risk during the pandemic were able to do so. Others chose to actually increase their risk. Why? To take advantage of potential new opportunities that were actually created by the crisis, something we'll talk about in just a moment. But now, let's get to another one of your questions. This one's from Jared in Texas. I noticed interest rates did rise quite a bit early this year. How did that happen? And why did it stop? Well, Jared, short-term interest rates are set by the Federal Reserve, right? And those are fixed, and those have not changed. So what I believe you're referring to are long-term interest rates, which are driven by the market. So you probably heard about these things called supply chain disruptions, where a lot of companies are trying to make goods, if you will, couldn't make as many goods as there was a demand for. Why? Because they couldn't get materials supplied to them. And of course, Economics 101 says when there's limited supply, increasing demand, the price goes up. So it's all these concerns about inflation that caused long-term interest rates to go up. Because the market knows that when long-term interest rates go up, the Fed then wants to raise short-term interest rates to try to combat inflation because it's one of their primary mandates. So Jared, great question and thank you. And if you have a question, just email me right here at AskDave@theretirementinComeStore.com. So let's bring back in Jeff Small. And also, let's now introduce our special guest, Dennis Gartman, retired editor and publisher of the Gartman Letter, and also a CNBC contributor, as well as the chairman of the Akron University Investment Committee. Dennis Gartman, thanks so much for being back here with us on the Income Generation.
Well, you guys are scraping the bottom of the barrel and found me once again, so here I am.
Well, we have a lot to talk about because we last spoke pre-pandemic, and of course the world got flipped upside down and right side up again. I know Jeff didn't get the chance to be with you last time, so Jeff, I'm going to defer to you.
So lots has changed over the last 12 months. What a whirlwind we've been on. But, we have to look forward from here, Dennis. We've got a flattening yield curve, inflationary issues, oil has doubled. There's going to be some headwinds, less pent-up demand going up next year. What's your forecast for the next 12 months in the markets at these new all-time highs?
Well, first of all, it's been a bull market, hasn't it? And it's been an extraordinary one founded upon the Fed's monetary expansionary policies. And it's not just the Fed, it's the Bank of Canada, it's the Bank of England, it's the ECB, it's the People's Bank of China. Indeed, the People's Bank of China over the weekend did something that used a 2x4 to the mule's head of the world of the Chinese economy by lowering the reserve requirements, which is the most expansionary circumstance you can get other than going out and doing what the Fed has been doing, which is buying Treasury securities. So it's been a bull market. It's probably going to continue to be a bull market. You can write this down. It's going to continue until it stops. That's the best that I've been able to come up with in 45 years of being in the markets. I'm surprised by how strong it has been. To be quite honest, there have been times in the past when I've been expecting to see the market correct. It corrects 2, 3, 4, 5% at most. It doesn't have 5, 10, 15% corrections. And as long as the monetary authorities remain expansionary, we probably have to continue to think that the market will continue to move from the lower left to the upper right. It's been a bull market. Don't fight it. Don't fight the Fed.
Yeah, with these expansionary tactics by the Fed, it sure seems like they're disconnected, but it makes me feel like they're worried about what could happen next. Is the variant going to become a player and there's going to be shutdowns again? Are there going to be foreclosure issues in the commercial space or the residential space? And so I'm concerned that they may never let the market fall. The next thing they could do is start buying stocks, right?
Well, first of all, the Bank of Japan has been buying stocks for a number of years. and has proven that they can continue to do that for a long period of time. I hesitate to think that the Fed will be in buying stocks, but there's no reason to think that they can't do it and won't do it if push comes to monetary shove. They have that capability. I'm surprised by the discussions of it, but they can do it. When they do it, they'll do it via ETFs. They won't come in and buy individual shares. They'll buy ETFs just the same way the Bank of Japan has done it. It's some time yet before they actually attempt to do that, and they probably won't do it unless we see that this new derivative of COVID becomes much worse. I hope that that's not true. I hope that doesn't happen.
Well, they just bought a bunch of corporate ETF bonds, right? And they're offloading their bond balance sheet. I think they bought $14 billion in corporate bonds to reassure the credit markets. I mean, last year they virtually guaranteed every bond in America, municipal or corporate.
Yes, they in fact they did. They bought every Treasury security. Well, I shouldn't say they bought every Treasury security, but they bought 75 or 80% of the Treasury supplies. The Fed has been monetizing the Treasury's debt. And they're going to continue to do that. They've made the promise that they're going to continue to do $120 billion worth a year. And I see no reason to think they're going to change that anytime soon.
So Dennis, what are your thoughts about inflation? What are your thoughts about inflation, Dennis? It's been, is it transitory? Is it more permanent? What's your crystal ball say?
I don't think it's going to be transitory. I think that this is a rather permanent circumstance that's prevailed, unless the monetary authorities suddenly decide to have a massive tapering of their purchasing of Treasury securities, unless they actually start to begin to sell Treasury securities, which they'll never do. They'll only let things roll off, but they're going to continue to buy. And as long as they do that, as Professor Friedman taught us, inflation is always and everywhere a monetary phenomenon. And you can't grow the monetary base, the adjusted monetary base, which is the stock from which all other monetary aggregates are derived. You can't have the adjusted monetary base growing 25, 26, 27% per annum without having an aggressive inflation. So the numbers that we start to see in the past several weeks, yesterday or 2 days ago, we saw CPI, yesterday we saw PPI, both of them well above the worst expectations, showing inflation to be running 5 and 6 and 7% per annum. That's going to be, I think, something we're going to have to live with for a long period of time going forward. Now, yes, indeed, there are exogenous circumstances, pipeline availabilities, the problem that occurred in the Suez Canal earlier this year, the backups at the nation's ports here in Norfolk, where I live, or in Los Angeles on the West Coast, even in Seattle on the West Coast. We've had backups in those ports and the inability to get ships in and out. Now, those have been I think those are transitory, but the real problem, the monetary authorities have been expansionary and see no reason to think they're going to change. So this is not a transitory inflation. This is an indigenous, long-standing circumstance that I fear may get worse.
And the textbook says, of course, that the Fed should be raising rates to fight off inflation. But so is that our biggest threat? Briefly, is that our biggest threat now to the financial markets? The one thing that's most likely to topple them when the bull market eventually does end?
As long as we don't get inflation above 4 or 5% on a consistent basis, I think we can live with it. It's hard for me to believe at 70 years old that I actually would say that make that comment, but I guess we're going to have to learn to live with 4 or 5 or 6%. And the stock market can probably take that in stride without being too deleteriously affected. When you start to get above 7 and 8% inflation, and that is a possibility. It's not a probability, but it is a very distinct possibility. Mm-hmm. When you start to get to 7 and 8% inflation, that can be very detrimental to the stock market. So what does the stock market fear more than anything else? An inflation rate that gets to 7, 8, 9, 10%. And again, with the monetary base expanding at 20 and 22 and 25 and 28% per annum, depending on which starting point you use, you're going to get higher levels of inflation, and you have to be on the watch. So I think the trade is to still own stocks, but at the same time own gold, which normally the two move in contravention one to another. I can make the case that they both move in convention one with the other, both moving from the lower left to the upper right.
Yeah, my biggest concern is that even at 4 or 5%, traditionally the Fed overreacts, starts to push us toward recession, and that affects the stock market. But like you said, I said it perfectly. The bull market will continue until it no longer continues. Dennis Gartman, thanks so much for being back with us here on The Income Generation.
It was my honor.
And coming up, we'll talk more about another lesson learned from the pandemic, the importance of estate planning. All that and more right after the break.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton, and thanks for tuning in as we discuss the 4 financial lessons learned from the COVID-19 crisis. And so far, we've covered the importance of having a strategy that expects the unexpected, but also a strategy that's flexible. So now let's discuss how the pandemic reinforced the need for estate planning. Remember, the majority of people who died from COVID-19 were over age 65. Some of them were on life support before they died. How many families struggled with the ultimate hard choice because they had no advance care directive? How many victims of the virus died without leaving a will? As an advisor, I talk a lot about the importance of estate planning because without an estate plan, all your assets from your money to your property may end up being distributed by the courts after you die. And as a result, your family could end up fighting and they could end up burdened with legal fees as they try to sort things out. So here's the point. Estate planning isn't something that you put off until you're hit with a life-threatening illness. It's something you do to prepare for the possibility of such illness or any other tragedy. The pandemic offered us a stark reminder that tragedy can strike at any time, and that the older you get, the more vulnerable you are to a major health threat. At the same time, it's important to realize that estate planning isn't just about protecting and distributing your assets after you've died, because it's a crucial part of protecting and managing those assets during your retirement years as well. Now let's get to another one of your questions. Alexa from Pennsylvania asks, isn't estate planning mainly important for wealthy people? Actually, no. Because again, estate planning affects everything from your savings accounts to your home, if you own your own home or condominium, virtually everything you have. It affects your car. And one of the biggest myths I hear is that it's only for affluent individuals because people say, well, I don't have an estate. Well, you do. If you own anything or have any savings, you have an estate. And the good news, Alexa, is it's not very difficult to plan. You know, typically for a few $100s, a good attorney can help you. And if you have an income specialist that you're working with, that income specialist can actually maybe even lower those costs because they can get you set up thinking about all the things you need to consider and the decisions you need to make before you go to the attorney and before the clock starts ringing in terms of attorney fees. So Alexa, great question. Thank you. And be sure to send me your retirement questions by emailing us right here, askdave@theretirementincomeStore.com. So Jeff, hopefully, you're seeing what I'm seeing now, that hopefully more people are listening to our message about the importance of estate planning, and maybe it's not falling on deaf ears quite as much as it has in the past.
It's really not, Dave. With the COVID virus last year, estate planning became more of a front and center topic for folks that were over 60, especially the ones that didn't get their estate planning done in time. And so, there's lots of contingencies to cover, but estate planning really is part of a 3 or 4 cornerstone process for retirement planning. And it's got to be one of the top things folks have to consider today to make sure they have their situation resolved and their affairs in order.
Yeah, it definitely is. I mean, I would say, and I think you're saying the other two are probably planning for Social Security, planning for RMDs, but you're right. Estate planning is the one big thing that people tend to miss that I think they need to be reminded of.
Yeah, it's something that we really weren't thinking about prior to COVID, but with the inception of all this death in the news and higher mortality rates due to a virus that were very flu-like, it became very important for folks to, run out, see their attorney, find a legal professional that could manufacture their estate plan so they didn't leave a mess. They didn't end up without an advance care directive or in probate or without a power of attorney for health care or financial decisions. So a number of reasons to get out there and get it done.
You're 100% right. The advance care directive is as important sometimes, if not more important, than the actual will itself. Because it says who's going to make healthcare decisions for you if you're in a coma and you can't make those. And of course, the living will helps guide that person as to what the decisions are that need to be made. And in addition to that, you also have a durable power of attorney, which now appoints somebody to make financial decisions, so that every time somebody needs to go to the court to take a withdrawal, to pay for something, to pay one of your bills, they don't have to pay court fees. Now, with that durable power of attorney, boom, they snap their finger, and guess what? They can go ahead and write a check. It's really simple. So you're right, a lot there other than just, what happens to my money, when I die. So let's bring in now our next guest, which Jeff, of course, is one of your good friends and right in your backyard here on the east coast of Florida, and that's Mike Burleigh. He's the president of Peak Capital Management, a retirement income store located in Jensen Beach, Florida. Mike, thanks so much for being back with us here on the show.
Hey, Dave. Thanks for having me back.
Mike, it's great to see you. We've had quite the run in the stock market since the COVID crisis in March of last year. Income planning and investing in fixed income has never been more important at these all-time stock market peaks. Give us your take.
Well, yeah, these things don't run forever. At some point, we're going to have a correction. I think the biggest risk to retail clients or retail investors is they really don't understand market volatility and what can happen. Not if we get the next downdraft, it's when we get the next downdraft. At that point, you're going to need to have some interest in dividends coming in to supplement your retirement.
So you think it's going to be a lot more challenging for the market to continue this massive expansion with all the headwinds we might have going forward the next 12 months, Mike?
Well, look, we've had a great run this year. Can we have this kind of run for the rest of the year? Hard to say. Personally, I don't know. I don't think so. I'm cautiously optimistic. We've got some, different variants of the Delta coronavirus. We've got the debt, borrowings out of control. I mean, these things could play into it. They could be factors. So, hard to say. I mean, there was an article in the Wall Street Journal yesterday, and they kind of likened it to flat screen televisions. The more inexpensive the government debt becomes, the bigger it gets. So to me, that could be an issue down the road.
That's an interesting analogy, but we also have inflation. And recently, Mike, we had this huge demand for things like lumber, and lumber prices have just crashed because everybody said, we're not paying those prices anymore. And so I kind of see a tulip mania in stocks as well because they've been run up so high, the valuations are so high. So income planning really is the central barometer for folks to avoid the next stock market drop and get earnings. Or is that what you're doing for your customers?
We invest for the known first. And what I mean by that is we invest for the interest in dividends first. Growth becomes secondary in retirement, not primary. That's the distinction, Jeff.
Yeah, and you could do that even in the stock market, of course, as I know you do, where investing in interest and dividends doesn't mean being out of the stock market. You can still be in the growth game and get some interest in dividends. But I guess the question is, how many of your clients do you think learned something about themselves and their own risk tolerance levels when the market took this major drop in March of 2020?
Well, I think it was a wake-up call for a lot of them. When they saw that market drop over 30% in a very short period of time, I think they came to the realization that, markets don't always just go up, up, up.
Yeah.
And if they need income, they better have be invested for some income, have some interest in dividends coming in, supplement their retirement plans.
That's right. Hopefully they did. My fear was that Congress jumped in too quick, the Fed jumped in too quick, and people have gotten used to this. Oh, bear markets recover after only 2-3 months. So you've been around long enough to know that's not always the case. So what are your final words of wisdom for those people who are watching and listening that are either retired or within 10 years of retirement?
I think if you're within 10 years of retirement, the name of the game is to start transitioning from the accumulation phase of your money to more of a preservation and distribution phase of your money. Like I mentioned earlier, you cannot eat growth. You have to have income to supplement your retirement. For a lot of folks, that could be, Social Security money only be 50% of the retirement, 40% of the retirement. They're going to need to supplement that with interest and dividends rather than liquidate principal.
Yeah, and what's neat about that is, Mike, as you know, that's not something that we learned, a lesson from the coronavirus crisis. That's always been good wisdom. So it's about getting back to basics. So as usual, Mike, thanks so much for your wisdom, and thanks so much for being such a friend of the income generation.
Hey, thanks, Dave. Good talking to you guys.
And same here. And we will be talking coming up about the fourth financial lesson learned from the coronavirus, the importance of holistic retirement planning. We'll also have a special guest, David Stearns. All that and much more on the income generation. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749, online at theretirementincomestore.com.
Welcome back to the Income Generation. It's great to have you. I'm David Scranton, and today we're looking at 4 financial lessons from the COVID-19 crisis. And so far, we've discussed the importance of expecting the unexpected, of being flexible, and of having an estate plan. So now, let's talk about having a holistic plan. Let's face it, health is wealth. And that saying resonates more strongly than ever following the coronavirus crisis. What also resonates is the importance of holistic retirement planning. And that means planning that encompasses virtually every aspect of what it means to be healthy. Not just your financial health, but also your physical, mental, and emotional health. Let's face it, your financial security isn't worth much at all if you're not physically fit enough to enjoy it. And neglecting your physical health can make you more vulnerable to something like a deadly virus, such as the COVID-19 situation. And what's more, poor physical health is more likely to affect your financial health. The need for more and costlier health care already increases as you get older. So ignoring preventative care and making unhealthy lifestyle choices are sure to increase it even more. And by the same token, it's a fact that mental stress can affect you physically. That means if your financial plan is creating a lot of stress in your life, it may be unhealthy in more ways than you realize. Here's the point. Physical, mental, and financial health are all naturally intertwined in some way. So it only makes sense to consider them all by taking a holistic approach to retirement planning. And in many ways, investing for income gives you that holistic approach. Why? By helping you build a strategy geared specifically toward your retirement goals. A strategy designed to help reduce financial stress. So now let's take one more question from you. Marianne from Nevada asks, how do I know if a certain advisor specializes in investing for income? Well, Marianne, the important thing is to ask the questions. So when interviewing an advisor, and we always recommend you interview several, you start by saying, okay, what do you think, generally speaking, for somebody my age at my stage of life, what percentage you think they should have in the stock market versus bonds and bond-like instruments? And if they say that you should have 60 or 70% in the stock market, or most of their clients do, then that's probably a clue that they're not income specialists. Then you could turn around and ask, hey, on your stock market-based investments, what's the average dividend yield? Is it closer to 1, 2, 3%? Tell me about that. And again, if they say 3% or more, okay, maybe that's a good sign that person could be an income specialist. If they say 1 or 2, that means they're focused on total return, like most financial advisors around the country. So Marianne, great question. Thanks so much for asking. And once again, be sure to send me your retirement questions by emailing me at askdave@theretirementincomestore.com. And now let's talk again with Jeff, who, by the way, if you're a regular viewer, you might recognize that over the last year or so, Jeff has taken a more holistic approach to his health. Because, Jeff, you've lost a few lbs in the last year or so, have you not?
I have. We're all in a constant state of trying to go backwards with our weight. But, Dave, good health is no guarantee for anyone. But we can all make smart or dumb choices. And one of the smartest choices we can make right now is to get the vaccination. The vaccination prevents mortality with the new Delta variant. And so with just that fact alone, the risk is too far great. The reward is much better. Get the vaccination for smart health decisions presently.
Yeah, very true. I didn't think you were to go there, but I'm glad you did, because it is. But also, other things that people do. It's just doing a little bit of exercise. Taking a walk. I was up in Connecticut last week, and I saw my neighbors who they like to go to this restaurant every Friday night. It's their date night together. And it's not that far away, but usually you drive. And they were walking to the restaurant. And I thought, God, what a great choice. It was a beautiful night. Why wouldn't you do that, right? And when you go there, it's an Italian restaurant. You don't necessarily have to get the pasta Alfredo or alla vodka, right? You can make a healthier choice. So like anything else in life, it's all about the choices we make, right?
It does, and smart health choices also go for reducing stress. Stress is the number one killer. It's the number one ager on our bodies, on our systems, on our minds. And so by having a relaxed life and a smart financial life adds to that de-stressing component, Dave.
And the most important thing I believe in reducing stress from a financial standpoint is being within your own risk tolerance level. Make sure you're satisfying all the income that you need through interest and dividends. And while you're doing that, make sure that, again, you're within your risk tolerance level. So if you see a major drop, like maybe you saw last March, you don't have stress and anxiety, you relax, you say it'll come back in time. I'm getting my income from my interest and dividends. At the end of the day, it really doesn't matter, because, think about it. Investing for income, by definition, is all about, as you know, Jeff, reducing stress in the first place. But now let's bring in our final guest, someone who knows a lot about investing for income and helping his clients reduce stress. David Stearns, founder and president of Stearns Retirement Group, a retirement income store located right outside of Atlanta, Georgia. David, thanks so much for being back with us on The Income Generation.
Hey, thanks, Dave. It's good to be back with you guys again.
I guess today we've got the two Daves on the show, Dave Stearns, Dave Scranton, which is great to see you again, Dave Stearns. So tell us what's going on in your world with your clients and how you're preparing your clients for these all-time record stock market peaks and what the 12 months looks like going forward.
Well, we're having a lot of fun. I can tell you that. My clients are vaccinated. Most of them are, and they're feeling really comfortable. It's great to see them again. I've had to calm some nerves, it seems, in the last year. But generally, we're optimistic about the next 12 months. We're prepared for just about anything. I was just whitewater rafting with my family a couple weeks ago in Colorado. And I tell you, you got to know your raft, you got to know the river, and you got to know your guide well. And I'm proud to be a guide working with my clients during this time. And the vehicles that our clients are in are doing exactly what they want them to do. You got to be ready at this moment, Jeff, for anything to happen at any time.
Well, I think that on that note, Dave, fixed income planning and fixed income investments for the income generation has never been more important because of these record levels and because the economy is going to be facing some headwinds going forward. I mean, the yield curve is already starting to flatten out, and the bond market's the best indicator for what's going to happen to the economy. We know that. And so give us your take on what you see happening in 2022.
Well, I'm optimistic about 2022. I think the inflation that we're experiencing is completely transitory. I mean, it would be different if we were experiencing inflation pre-COVID. We'd have to think this might be systemic, but when you shut the economy down and restart it. So I think it is transitory, and I think the Feds are committed through 22 to what they're doing with, even though they're tapering back the quantitative easing. I think there's a lot of money out there still. I'm pretty optimistic. The GDP looks really good. But, like you said, fixed income works. It's kind of an evergreen philosophy, Jeff. It kind of works in all conditions. I keep telling my clients that you're positioned for a time such as this.
Yeah, it's funny. It's funny because people, there's two schools of people I find, and maybe you can relate. I find that some people, when the market took a major drop in March of 2020, they learned a lesson. They said, okay, maybe I need to get more in line with my risk tolerance. Other people didn't, because the market came back so quickly because the unprecedented influence by the Federal Reserve and by Congress, they're kind of numb to that. And they think that every future bear market's going to be, 2-3 months long and everything will be better. How do you How do you get around that when it comes to clients' maybe false sense of optimism?
Yeah, I just have to remind them of market history. I have to remind them that, it's kind of like when we were whitewater rafting. We knew there was some level 4 rapids. We just didn't know where they were, but we had to be prepared for them, and we couldn't deny that they were out there. The reality is that this can't go on like this forever. It will settle back down. There will be some deep corrections to come, and I just have to continuously let them know. And as a good guide on the river, right, I have to be looking ahead and helping them understand what's to come. So, but I do have to hit that head on sometimes, Dave. Yeah.
And I love that analogy, the raft, the river, the guide. They know the raft, but they have to have the right guide who knows the river. And as we know, Dave, you're certainly the right guide to navigate people down the retirement river. So thanks so much for being back here, and thanks so much for just being a friend to the income generation.
Thank you so much. It was a pleasure to be with you guys today.
And thank you for joining me once again right here on the Income Generation. Of course, thanks to Jeff Small, as well as all of our guests. We've had a great time. Bottom line, if you're close to or you're in retirement and you're concerned about your money, as you know, it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and don't forget to tune in next week.